Money is seen with your mind. It's not what your eyes see, said Rich Dad. A piece of real estate is a piece of real estate. A company stock certificate is a company stock certificate. You can see those things, but it's what you cannot see that is important. It's the deal and the financial agreement, the market, the management, the risk factor, the cash flow, the corporate structuring, the tax laws, and a thousand other things that make something a good investment or not. He then proceeded to tear the deal apart with questions. Why would you pay such a high interest rate? What do you figure your return or on investment to be? How does this investment fit into your long-term financial strategy? What vacancy factor are you using? What is your cap rate? Have you checked the association history of assessment? Have you figured in management costs? What percentage rate did you use to compute repairs? Did you know that the city has just announced it will be tearing up the roads in the area and changing the traffic patterns? A major thoroughfares will run right in front of your building. Residents are moving to avoid the year-long project. Did you know that? I know the market trends is up today, but do you know what is driving that trend? Business, economics, or greed? How long do you think the trends will be up? What happens if the place is not rented? And if it isn't, how long can you keep it afloat and yourself afloat? And again, what goes on in your head to make you think that losing money is a good deed? This really has me worried. Rich, it looked like a good deal, I said, deflated. Rich Dad smiled. Rich Dad smiled, stood up, and shook my hand. I'm glad you took action, he said. Most people think but never do. If you do something, you make mistake. And it's from our mistake that we learn the most. Remember that anything important cannot really be learned in the classroom. It must be learned by taking actions, making mistakes, and then correction them. That is when wisdom sets in. I felt a little better and now I was ready to learn. Most people said rich dad invest 95% with their eyes and only 5% with their minds. Rich Dad went on to explain that people look at a piece of real estate or the name of a stock or often make their decision based on what their eyes see or what a broker tells them or on a hot tip from fellow worker. They often buy emotionally instead of rationally. That is why 9 out of 10 investors do not make money, said Rich Dad. While they do not necessarily lose money, they just do not make money. They just sort of break even, making some and losing some. That's because that they invest with their eyes and emotions rather than with their minds. Many people invest because they want to get rich quickly. So instead of becoming investor, they wind up being dreamer, hustler, gambler, and crook. The world is filled with them, so let's sit down, go back over this losing deal you just bought, and I will teach you how to turn it into a winning deal. I'll begin to teach your mind to see what your eyes cannot. From bad to good. The next morning, I went back to the real estate agent, rejected the agreement, and reopened renegotiation. It was not a pleasant process, but I learned a lot. 3 days later, I returned to see my rich dad. The price had stayed the same. The agent got his full commission because he deserved it. He had worked hard for it, but while the price remained the same, the terms of the investment were vastly different. By renegotiating the invest rate, payment terms, and the amortization period, instead of losing money, I was now certain of making a net profit of $80 per month. Even after the management fee and an allowance for vacancy was factored in, I could even lower my rent and still make money. If the market went bad, I would definitely raise the rent. If the market got better, I estimate that you were going to lose at least $150 per month, said Rich Dad, probably more. If you had continued to lose $150 per month based on your salary and expenses, how many of these deals could you afford? Barely one, I replied. Most people I do not have an extra $150. If I had done the original deal, I would have struggled financially every month. Even after the tax breaks, I might even had to take an extra job to pay for the investment. And now how many of these deals of $80 positive cash flow can you afford? Asked Rich Dad. I smiled and said, as many as I can get my hands on. Rich Dad nodded in approval. Now go out there and get your hands on more of them. A few years later, the real estate prices in Hawaii did skyrocket, but instead of having only one property go up in value, I had seven double in value. That is the power of little financial intelligence. You can't do that. An important side note to see real estate investment. When I took my new offer back to the real estate agent, all he said to me was, "You can't do that." What took the longest time was convincing the agent to start thinking about how we could do what I wanted done. In any event, there were many lessons I learned from this one investment, and one of those lessons was to realize that when someone say to you, "You can't do that," they may have one finger pointer forward at you, but three fingers are pointing backward at them. Rich Dad taught me you can't do that doesn't necessarily mean you can't. It more often means they can't. A classic example took place many years ago when people said to the Wright brothers, "You can't do that." Thank goodness the Wright brothers did not listen. $1.4 trillion looking for a home. Every day, 1.4 trillions orbit the planet electronically, and it is increasing. There is more money being created and available today than ever before. The problem is money is invisible. Today, the bulk of it is electronic, so when people look for money with their eyes, they fail to see anything. Most people struggle to live from paycheck to paycheck, and yet $1.4 trillion flies around the world every day looking for someone who wants it, looking for someone who know how to take care of it, nurture it and grow it. If you know how to take care of money, money will flock to you and be thrown at you. People will back you to take it. But if you do not know how to care for money, money will stay away from you. Remember, Rich Dad definition of financial intelligence is not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. The blind leading the blind. The average person is 95% eyes and only 5% mind when they invest, said Rich Dad. If you want to become a professional on the B and I side of the quadrant, you need to train your eyes to be only 5% of your mind to see the other 95%. Rich Dad went on to explain that people who train their minds to see money had tremendous power over people who did not. He was adamant about whom I took financial advice from. The reason most people struggle financially is because they take advice from people who are also mentally blind to money. It's the classic tale of the blind leading the blind. If you want money to come to you, you must know how to take care of it. If money is not first in your head, it will not stick to your hand. If it does not stick to your hand, then money and the people with money will stay away from you. Train your brain to see money. So what is the first step in training your brain to see money? The answer is easy. The answer is financial literacy. It begins with the ability to understand the words and the number systems of capitalism. If you do not understand the words or the numbers, you might as well be speaking a foreign language, and in many cases each quadrant represents a foreign language. If you look the cash flow quadrant, each quadrant is like a different country. They do not all use the same words, and if you do not understand the words, you will not understand the numbers. For example, if a medical if a medical doctor if a medical doctor y- your systolic is 120 and your dystolic is 80, is that good or bad? Is that all you need to know for your health? The answer is obvious no, yet it is a start. It would be like asking my stocks is 12 or my apartment house cap rate is 12. Is this all I need to know for my wealth? Again, the answer is no. But it is a start. At least we are beginning to speak the same words and use the same numbers, and that is where financial literacy, which is the basis of financial intelligence, begins. It begins with knowing the words and the numbers. The doctor is speaking from the S quadrant, and the other is speaking with the word and the numbers of the I quadrant. They might as well be different foreign language. I disagree when someone say to me it takes money to make money. In my opinion, the ability to make money with money begins with understanding the words and numbers. As my rich dad always said, if money is not first in your head, it will not stick to your hand. Know what real risk is. The second step in training your brain to see money is to learn to recognize what real risk is. When people say to me that investing is risky, I simply say investing is not risky. Being uneducated is risky. Investing is much like flying. If you have been flight school and spent a number of years gaining experience, then flying is fun and exciting. But if you have never been to flight school, I would recommend leaving the flying to someone else. Bad advice is risky. Rich Dad firmly believed that my financial advice was better than no financial advice. He was a man with an open mind. He was courteous and listened to many people, but ultimately he relied on his own financial intelligence to make his decision. If you do not know anything, then any advice is better than no advice. But if you cannot tell the difference between bad advice and good advice, then that is risky. Rich dad firmly believed that most people struggle financial because they operated on financial information handed down from parent to child. And most people do not come from financially sound families. Bad financial advice is risky, and most of the bad advice is handed out at home. He often said, not because of what is said, but because of what is done. Children learn by example more than words. Your advisors are only as smart as you. Rich Dad said your advisors can only be as smart as you are. If you are not smart, they cannot tell you that much. If you are financially well educated, competent advisor can give you more sophisticated financial advice. If you are financially naive, they must by law offer you only safe and secure financial strategy. If you are an unsophisticated investor, they can only offer low risk, low yield investment. They'll often recommend diversification for unsophisticated investors. Few advisors choose to take the time to teach you their time is also money. So if you will take it upon yourself to become financial educated and manage your money, well, then a component advisor can inform you about investment and strategies that only a few will ever see. But first, you must do your part to get educated. Always remember your advisor can only be as smart as you. Is your banker lying to you? Rich Dad had several bankers he dealt with. They were an important part of his financial team. While he was close friends with and respected his bankers, he always felt that he had to watch out for his own best interest, as he expected the bankers to look out for their own best interests. After my 1974 investment experience, he asks me this: when a banker say that your house is an asset, are they telling you the truth? Since most people are not financially literate and do not know the game of money, they often must take the opinion and advice of the people they tend to trust. If you are not financially literate, then you need to trust someone you hope is financially literate. Many people invest or manage their money based on someone else's recommendation more than their own, and that is risky. They are not lying, they are just not telling you the truth. The fact is, when a banker tells you your house is an asset, they are not really lying to you. They are just telling you the whole truth. While your house is an asset, they simply do not use whose asset it is. For if you are for if you read financial statement, it is easy to see that your house is not your asset. If it's the bank asset, remember my rich dad definition of an asset and a liability from rich dad poor dad. An asset puts money into my pocket, a liability takes money out of my pocket. People on the left side of the quadrant do not really need to know the difference. Most of them are happy to feel secure in their job, have a nice house they think they own, they feel proud of, and think they are in control of nobody will take it away from them as long as they make those payments, and make those payments they do. But people on the right side of the quadrant needs to know the difference. To be financially literate and financial intelligent means being able to understand the big picture of money. Financially astute people know that is more mortgage does not show up in an asset but as a liability on your balance sheet. Your mortgage actually shows up as an asset on a balance sheet across town. It shows up as an asset on the bank balance sheet, not yours. Your balance sheet, assets, liabilities, mortgage. Anyone who has taken accounting knows that a balance sheet must balance. But where does it balance? It does not really balance on your balance sheet. If you look at the bank balance sheet, there is story, the numbers, the number really tell. Asset, your mortgage. Now it balance. Now it makes sense. That is B and I accounting. But this is not the way it is taught in basic accounting. In accounting, you would show the value of your home as an asset and the mortgage as a liability. Also, an important point to note is that the value of your home is an opinion which fluctuate with the market, while your mortgage is definitely liability not affected by the market. For a B and I, however, the value of your home is not considered an asset because it does not generate cash flow. What happens if you pay off your mortgage? Many people ask me what happens if I pay off my mortgage? Is my house as an asset then? And my reply is in most cases, the answer is still no. It is still liability. There are several reasons for my answer. One is maintenance and the general upkeep. Property is like a car. Even if you own it free and clear, it still costs you money to operate. And once things start to break, everything begins to break. And in most cases, people pay for repair on their house and their car with after tax dollars. A person in the B and I quadrant only include property as an asset if it generates income through positive cash flow. But the main reason a house, even without a mortgage, is still a liability is because you still do not own it. Really, the government still taxes you even if you own it. Just stop paying your property taxes, and again, you will find out who really owns your property. That is where tax line certificate comes from, which I wrote about in Rich Dad Poor Dad. Tax line certificates are an excellent way to receive at least 16% interest on your money. If homeowners do not pay their property taxes, the government charge them interest on the taxes owed at rate from 10%. The government charge them in 10% to from 10% to 50%. Talk about usury. If you don't pay the property taxes and someone like me pays them for you, then in many states you owe me the tax plus the interest. If you do not pay the taxes and the interest within a certain amount of time, I get to take your house just for the money I put up. In most states, property taxes like purity in repayment. Even before the bank mortgage, I have had the opportunity to buy a house. I paid the taxes for less than $3,500. The definition of real estate. Again, to be able to see money, you must see it with your mind, not your eyes. In order to train your mind, you must know the real definition of words and the system of numbers. By now, you should know the difference between an asset and a liability. You should know the definition of the words mortgage, which is an agreement until death. The word finance, which means penalty, You will now learn the origin of the word real estate and a popular financial vehicle called derivative. Many people think derivatives are new, but in really they are literally age old. A simple definition of derivative is something that comes from something else. An example of derivative is orange juice. Orange juice is a derivative of an orange. I used to think that real estate meant real or something that was tangible. My rich dad explained to me that it really comes from the Spanish word real, which means royal. El Camino real means the royal road. Real estate means the royal estate.